When you do your Roth conversions, from what account should you pay your taxes? All right, so man Richard writes in. He says, hey, just watch a very interesting video on which accounts to take the taxes out of when you do a Roth conversion. Since I'll be moving a large portion of my TSP to a Roth, this floored me as I thought I would have to use extra TSP, extra T, I'll get extra T, TSP to help pay the taxes. The video I watched said to take the tax burden from my taxable account that I have as a capital gain as I get taxed at 15% for long term, and my traditional TSP would be 22% move, unless my AGI puts me in a lower than 15% bracket. Is this right? Yeah, so generally speaking, there's always a situation, man. A situation dictates. But when I did my Roth conversion this year, and I still can't believe I did not do one last year when I was telling everybody to do it, your old buddy Josh, what an idiot. Anyway, so I was telling people back in March of last year, do your flipping Roth conversions. But anyway, so long story short, I waited from March of last year till May of this year, a good 14 months, and the market just went zoops like a skyrocket, and I just was stupid. Anyway, I didn't do it. But I did a Roth conversion. Look at something on my face. Yeah, dude, what is that? I did a Roth conversion, and I have to pay the taxes. I'm paying the taxes from my account, my savings account. I'm not, well, for me, because it's an IRA and I'm under the age of 59, you don't want to pay taxes from your IRA to do a Roth conversion because that's a premature distribution and not only be subject to income taxes, it'll also be subject to penalty. The Roth conversion is not subject to penalty, but the amount for which you take from your retirement, your pre-tax account to pay the taxes will be taxed and subject to penalty. So you don't want to do that if you're under the age of 59 and a half. So in this case, you got taxes to pay. It's got to come out of a brokerage account or a bank account. No, there's no two ways around that. So my man here, Richard, will assume he's over 59 and a half just for simplicity. He's taking it from his TSP, doing a Roth conversion. Yeah, absolutely. So ideally, you'll do a Roth conversion. We'll just say $100,000, and we'll just say for simplicity, it'll put you at the top of the 22% threshold. All right. So basically, if you pull more from your traditional TSP to pay the taxes, that's going to put you over the 24%. Not a big deal, but generally speaking, we still like to play the tax bracket game. And don't do that. So you need $25,000, $22,000 on the Roth conversion. It's got to come from someplace. So that's it. Well, you don't actually. Well, I guess you would need $22,000 because you're in a 22% tax bracket. So basically, you're going to need $22,000 to convert $100,000. If you pull the $22,000 out of your TSP, that's another $22,000 distribution, and that won't be subject to a 22% tax. That'll be subject to 24% tax. Conversely, if you have the money in a brokerage account or a bank account, and let's just say it's a bank account, well, there's no tax there because it's just sitting in cash, and there's no capital gain or anything like that on a bank account. And that's what I did. I said, okay, I'm going to pay my taxes. I'm going to pull from my bank account. Done. All right. Now, again, if you have a brokerage account, not again, but if you have a brokerage account and you have long-term capital gains in there, you're either going to sell the shares at a long-term capital gain. In this case, it will be subject to 15%. It could even be 23.8, depending on where your total income is. But in this case, it'll be 15. 15 is 100% better than 24 because, again, you're already at the top of the 22% threshold for the tax bracket. It's just tax bracket management. But remember, long-term capital gains are always and everywhere taxed more preferably than ordinary income every single time. So we want to take the money from your brokerage account as opposed to the TSP if we can. If you have a checking account, we have money in the checking or savings account or a CD, take it from that so you don't have to even do a taxable event from your brokerage account. I hope that makes sense. But that's the reason you want some money on the side. Because to pay the taxes on a Roth conversion is no different than getting a roof put in. You need the liquidity to do things with. So that's why you want to build a checking account and a savings account or a certificate of deposit. Just keeping some cash on the side. You can never go wrong with having some cash. I'm just telling you right now. Seems like I had something else I was going to say. Let's only think about it. Be a little bit more confusing here. But remember, the brokerage account, there is something called specific identification. You can identify the shares for which you want to sell. And theoretically, you can take, let's say you have $50,000 in VTI. All right, I'm just using that for example. $25,000 is the cost basis, so it's worth $50,000. You can go in there and say, I want to sell my cost basis as a return of principal and just leave the rest as unrealized gain. And that return of principal is basically selling the cost basis that is not subject to any income tax, no long-term capital gain, because you're just touching your principal. You're not touching the gain, if that makes sense. Now, that leaves nothing but gains for the future. So whenever you sell that capital gain, or that's the $25,000 that's left, that will be subject to long-term capital gain. Well, okay. I mean, deferring taxes a lot of times is better than paying it now. Not always, which is why we're doing the Roth conversion to begin with. But remember, look into your brokerage accounts, and you can always see specific identification. I want to specifically say, these are the shares I want to sell, and I want to leave those ones outstanding. Confusing, but it's worth knowing the tax code. All right, love to hear your thoughts. See ya.